Most people tracking XRP are watching the wrong number. They watch the dollar price. They compare it to last year's high. They measure how far it is from the all-time high. They ask whether it can reach $3, $5, $10. All of those comparisons share one flaw. They compare XRP to its own past prices in dollar terms. The more revealing comparison is not XRP versus its past dollar price. It is XRP versus Bitcoin right now, today, compared to where that ratio was the last time both assets ran simultaneously in a real bull cycle. And that number will stop you. The XRP to Bitcoin ratio, how much Bitcoin one XRP is worth, is currently sitting 90% below its 2017 peak. Not below some speculative projection. Not below an analyst price target. Below the level it already reached once, in a market environment that had a fraction of today's institutional infrastructure. Zero spot ETFs, no legal clarity, and no Goldman Sachs position in XRP products. 90% below a level it has already been at. Here is what that 90% discount actually implies in dollar terms. If the XRP BTC ratio simply recovers to where it was in 2017, not to some new speculative high, just to the historic norm it has already reached. At current Bitcoin price levels, that implies an XRP price somewhere in the $17 to $20 range. Not a moonshot, a ratio recovery. The math of a number returning to where it already was. And the conditions that produced the 90% discount, the SEC lawsuit that kept institutional capital on the sidelines in 2021 and suppressed the ratio through this entire period, are gone. The SEC settled in August 2025. The anchor that created the discount was removed. The ratio has not recovered yet. That gap is the thesis. So here is the question that the ratio data forces. If the structural reason the XRP BTC ratio is 90% below its 2017 level, the SEC lawsuit no longer exists, and institutional infrastructure that did not exist in 2017 is now live and funded. Goldman Sachs alone holds $154 million in XRP ETFs. What is keeping the ratio compressed? And what specific, datable, documentable events need to happen before the compression releases? Welcome to XRP News Flow Signals, where we track the ratios, not just the dollar prices. This is not financial advice. Always do your own research. But if you want to understand why the XRP BTC ratio is the most revealing metric in this market right now, and what the 4 documented triggers are that historically produce the rotation that closes that 90% gap, stay with me. We build the analytical case from primary data, not from narrative. Let's start with the historical precision that most cycle analysis glosses over, because the 2017 parallel is more specific than most coverage acknowledges. At the start of 2017, XPR was trading at less than 1 cent. Less than 1 cent per token. Bitcoin started that year around $1,000. By December 2017, Bitcoin had gained approximately 1,900%, from $1,000 to near $20,000. A historic, generational move. XRP gained approximately 35,000% that same year. Bitcoin went up roughly 20 times. XRP went up roughly 350 times. In the same 12-month window. In the same market cycle. The mechanism was not random. Bitcoin leads every bull cycle's first leg because it is the asset that institutional and retail capital understands first. The institutional on-ramp. The safe version of crypto. Once Bitcoin breaks out and confidence builds, capital rotates into large-cap altcoins, chasing the next multiple. Investors who already own Bitcoin start looking for what has room to move. In 2017, XRP was the obvious answer. Real use case, real bank partnerships, and it had barely moved relative to Bitcoin's run. The rotation followed the thesis perfectly. 2021 was setting up identically, until it wasn't. Bitcoin hit new highs. The market moved. XRP started gathering momentum. Then, the SEC lawsuit that had been hanging over Ripple since December 2020 began to bite structurally. Institutions that might have allocated XRP held back. The legal cloud kept a ceiling on how far the rotation could go. XRP never made an all-time high that cycle, while Bitcoin and Ethereum both did. That is the origin of the 90% ratio discount we are looking at today. Not a market judgment about XRP's value, a compliance judgment about XRP's legal status, a judgment that was resolved in August 2025 when the SEC settled. The discount was created by a specific cause. The cause was removed. The discount persists. That gap between removed cause and unreflected discount is the precise structure of every major ratio recovery trade in financial history. But here's what most ratio analysis stops short of explaining. A ratio can be compressed by a removed cause and still stay compressed indefinitely unless specific conditions exist in the market to trigger the release. And there are 4 specific, documentable, observable conditions that historically have triggered exactly this kind of altcoin rotation. 2 of them are already partially in motion. 2 of them have specific dates attached. Let me map them precisely. Let's be precise about the conditions required for the XRP BTC ratio compression to release, because vague rotation incoming language is not useful. Specific, observable, datable triggers are: Trigger 1. Bitcoin dominance below 55%. Bitcoin dominance, the percentage of total crypto market capitalization held by Bitcoin, is currently sitting at approximately 59%. Historically, the major altcoin rotation events in 2017 and 2021 both began when Bitcoin dominance broke below 55% with conviction. At 55%, capital starts flowing out of Bitcoin into large-cap altcoins with room to move. Below 50%, the rotation is in full effect. The signal to watch: Bitcoin dominance trending below 55% on increasing volume. That is when the capital rotation from Bitcoin into large-cap altcoins historically accelerates. XRP, with the largest institutional infrastructure of any large-cap altcoin, is structurally positioned as the primary rotation destination. Trigger 2. Clarity Act Committee Vote. The Senate Banking Committee markup is targeted for late April into early May. When this vote happens, not when the bill becomes law, but when the committee votes, every institutional legal team treating regulatory clarity as their entry prerequisite gets the signal. The committee vote tells them the direction is confirmed. Positions can be built before the final bill becomes law. Goldman Sachs's $154 million position, representing 73% of all U.S. institutional XRP ETF holdings, did not arrive by accident. It arrived because Goldman's legal team made a determination that the regulatory trajectory was clear enough to build a position. The committee vote formalizes that trajectory for the next tier of institutional capital that has been more conservative in its weight. Trigger 3. XRP above 145. Approximately 60% of XRP token holders are clustered at the $1.44 to $1.45 resistance zone. Wallets that bought at or near that average cost basis and have been underwater or at break-even since. Every time XRP approaches that level, break-even selling creates resistance. A clean break above $1.45 on strong volume signals that the selling pressure from those holders has been absorbed. The wall is gone, and the path above is structurally cleaner. Trigger 4. Weekly ETF inflow divergence. When institutional capital is genuinely rotating into XRP ahead of a major move, the ETF data shows it before the price does. The specific pattern to watch: sustained strong weekly XRP ETF inflows, while Bitcoin ETF flows are flat or declining. That divergence, institutional money moving toward XRP while staying neutral on Bitcoin, is the institutional fingerprint of the rotation beginning. XRP has already demonstrated both triggers 3 and 4 in this cycle. In January 2026, XRP gained 25% in the same week, Bitcoin gained 6%, and Ethereum gained 10%. In February 2026, after a market-wide correction, XRP recovered 38% from its lows, while Bitcoin recovered 14% and Ethereum recovered 12%. Both moves happened while Bitcoin and Ethereum ETFs saw outflows and XRP ETFs maintained inflows. Two short-term outperformance already documented this cycle. 4 triggers, 2 partially in motion, 2 with specific dates. Now, before you take the 4 triggers as a clean roadmap and stop there is one honest constraint on the XRP outperformance thesis that most analysis downplays because it doesn't fit the bullish narrative. And if you don't understand it, you'll be confused when the rotation starts and XRP's percentage moves don't look like 2017. Let me be direct about what the math actually requires at this scale. Here is the analytical honesty that this thesis requires. In 2017, XRP went up 35,000%. That move was a function of how small XRP was. At a fraction of a cent price with a tiny market cap, the same amount of money flowing in produced an extraordinary percentage gain. Today, XRP has a significantly larger market cap. The same percentage move requires a proportionally larger amount of capital to produce it. A 35,000% year is not on the table. That number was a function of starting from near zero in a market with no institutional infrastructure, no ETFs, and a market cap so small that a relatively modest amount of capital created extraordinary percentage moves. What is on the table, if the 4 triggers align, is an XRP BTC ratio recovery toward historical norms. And at current Bitcoin price levels, that ratio recovery implies an XRP price in the $17 to $20 range at conservative historical norm recovery. A multiple 100% move from current levels. That is not a disappointment relative to 2017. That is a structurally grounded projection based on a ratio returning to a level it has already occupied, with the institutional infrastructure to make that return sustainable, rather than a brief spike and reversal. The second honest constraint, the Clarity Act, remains the single most important legislative risk. If the Senate Banking Committee markup stalls and the August window closes without passage, the institutional green light does not fully switch on. Some of the capital waiting on the sidelines stays there. The ratio compression continues longer than the 4-trigger thesis suggests. The bill stalling is the single largest risk to this thesis. Acknowledging that is not pessimism. It is the analytical honesty that makes the rest of the thesis credible. And that brings us to the supply data. Because while the 4 triggers and the ratio math are the analytical framework, there's an on-chain signal that has been quietly confirming the thesis from a completely different direction. And the number attached to it is one that most channels never reach in their analysis, because it requires reading the exchange flow data rather than the price chart. This is the part that connects the ratio math to the behavioral reality of what large XRP holders are actually doing right now. I want to pause here, because mapping the XRP BTC ratio to the 4 specific rotation triggers, to the honest constraints, to the on-chain supply confirmation, as a single coherent analytical structure rather than separate data points, is exactly the work this channel is built to do. If you want this level of cycle-aware signal analysis in your feed consistently, subscribe to XRP News Flow Signals right now and turn on notifications. Because the specific moment Bitcoin dominance trends below 55% alongside a Clarity Act committee vote is the most datable, observable convergence event in this entire thesis, and you want the framework already built when those 2 signals align. Here is the supply data that the on-chain record shows, and it confirms the ratio thesis from a behavioral direction. Since the start of 2026, more than 570 million XRP tokens have moved off exchanges and into long-term storage wallets. That is over $750 million worth of XRP that large holders have withdrawn from the market-accessible float. permanently into cold storage positions that historically do not move until a price target or thesis event triggers a decision to sell. Exchange balances are at their lowest level since 2021, the last time XRP was approaching a major move. This is not retail behavior. Retail does not move $750 million into cold storage with methodical consistency over the course of a year. This is large holder behavior, the behavioral signature of entities that have made a long-term assessment and are positioning to wait, not to trade. Combined with the ETF picture, $1.37 billion in cumulative XRP ETF inflows with 0 days of net outflows since launch. Goldman Sachs alone holds $154 million across 4 XRP ETFs, representing 73% of all U.S. institutional XRP ETF holdings. That is not 73% of all ETF value. That is 73% of all disclosed U.S. institutional ETF positions. Goldman is the dominant institutional position in U.S. XRP ETF products right now. Goldman does not build dominant positions in ETF products without a thesis and a timeline. The timeline they are operating on is the same 4-trigger framework we just mapped, and their position size suggests their legal team has already made the determination that the Clarity Act's direction is confirmed. The supply is leaving exchanges. The institutional money is parked and waiting. The ratio is 90% below its historic norm, with the cause of that discount removed. The on-chain data and the ratio data are telling the same story from 2 different directions. Let's add the macro context that makes this cycle structurally different from every previous one, because this is the dimension that most 2017 comparison analysis misses entirely. In 2017, XRP's bull thesis was about cross-border payments, banks adopting faster settlement rails, the elimination of correspondent banking inefficiency, real enough to drive a 35,000% move, but still largely aspirational at the time. In 2026, that thesis has been confirmed and expanded. Coinbase's most senior policy executive stated publicly this week that every market will become tokenized, describing token-based capital market activity as compressing settlement from T+1, T+2, T+3 to instantaneous, with incorruptible public recordation of ownership. That is not a crypto advocate making a promotional statement. That is a policy executive describing the institutional direction of global capital markets on mainstream financial television. The IMF is already discussing regulatory coordination for cross-border tokenized asset flows. The conversation has moved from will tokenization happen to how do we regulate it globally. XRP's Ledger. 4 billion transactions over 14 years of uninterrupted operation is the most battle-tested settlement infrastructure in this space. When institutional capital from tokenization flows require a settlement layer that operates at institutional scale, continuously, at negligible cost, the XRP Ledger is not one option among many. It is the operational record holder. In 2017, XRP was a thesis about what could happen. In 2026, it is an infrastructure proven to be capable of what is already happening. That is the dimension the ratio comparison doesn't fully capture. And it is the reason the ratio recovery thesis, if it plays out, may be more sustained than the 2017 version. Let me leave you with the complete frame. The XRP BTC ratio, it's 90% below its 2017 historic level. The cause of that discount, the SEC lawsuit, was resolved in August 2025. The discount persists. The gap between removed cause and unreflected discount is the thesis. 4 triggers need to align for that gap to close. Bitcoin dominance below 55%. Clarity Act committee vote. XRP break above $1.45. And sustained ETF inflow divergence. 2 have already shown early signals this cycle. 2 have specific dates. 570 million XRP have moved to cold storage since the start of 2026. $1.37 billion in ETF inflows with 0 days of net outflows. Goldman Sachs holding 73% of all U.S. institutional XRP ETF positions. The supply is leaving the market. The institutional money is parked. The ratio is compressed by a cause that no longer exists. The honest constraint, the Clarity Act, remains the critical legislative variable. If the August window closes without passage, the timeline extends. The thesis survives. It just operates on a longer clock. But the ratio math does not care about the timeline. It only cares about whether the conditions align. And the documentation of those conditions building in on-chain data, in ETF flows, in institutional positioning has never been stronger. If this ratio-based analytical framework changed how you measure XRP's position in this cycle, subscribe to XRP News Flow Signals before the Bitcoin dominance signal breaks below 55%. We track the 4 triggers, the supply data, and the institutional positioning, and we map the rotation before the price reflects it. Drop one word below, ratio, if the 90% discount framing reframed your read on XRP's current position. Let's see who is tracking the right number. Stay sharp. The signal does not lie. Not financial advice. Always conduct your own research.